We were discussing financial markets. We talked about case one earlier. So if we go back, so we talked about the case where the only bank in the economy is the central bank and there are no private banks. Money is only supplied by the central bank. There's only one type of money currency controlled by the central bank. We now want to discuss case two, where the economy has a central bank along with private banks collecting deposits. Money is supplied by the central bank in the form of currency and private banks in the form of deposits. Because remember, we said there are two types of money, currency and deposits. Money can take the form of either currency controlled by the central bank or deposits created by created by private banks not controlled by the central bank. To understand this case, we must first look at what do private banks do. Now, banks receive funds from people and firms, which is what we call deposits. Now, banks keep as reserves some of the funds they receive. So, some of the deposits that you receive, you keep them as reserves. Now, reserves are those part of deposits that commercial bank receives that it keeps on hand and that are not lent out. Now, this is required to meet demand for withdrawals by depositors, to pay checks drawn on depositors' accounts, and also to meet central bank's required reserve ratio. Now, this is the percentage of deposits that the central bank requires that the private banks keep as reserves. So, total reserves can be divided into two categories: reserves that the central bank requires banks to hold, and any additional reserves that banks choose to hold, which are called excess reserves. And the reserves that central bank requires banks to hold is what is called the required reserve ratio. Now, some reserves are held as cash in banks themselves, but most are held as deposits at the central bank. So, like you said, banks receive funds from people and firms, which is what we call deposits. Now, banks keep as reserves some of the funds they receive, and the rest of the deposits are used to make loans. So, this is the basic idea behind reserves, deposits, and funds. So, bank is receiving funds from people and firms, which we call deposits. So, those deposits are kept as reserves. Some of these reserves are required reserves, and some may be excess reserves. And the rest of the deposits are used to make loans.